We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Drew Wahlgren of MAG Capital Partners. Drew, how are you today?
Doing well. Thanks for having me on the podcast, Casey.
Absolutely, man. Absolutely. You know, we heard you on Kevin Bupp's podcast, and I really thought that you brought a lot of value there, and I thought that it was worth reaching out and seeing if you could maybe bring some of that to our audience as well. And I know you specifically, and I know it's it can tend to be a little bit of a dry subject when you get onto triple net leases, but at the same time, it's one of those almost like you almost have to know it or have to learn it in order to really appreciate what it can do for your investors, what it can do for your business, what it can do for everybody all the way around. And I know that typically in this space, myself included, are scared of the types of properties that come along with triple net, mostly being like shopping centers and common area stuff. So why don't you tell us a little bit about who you are, what MAG is, and we'll just kind of go from there and see where it leads us.
Yeah, first of all, I don't find it to be a dry subject. So hopefully I'll change that for you. I'll change that for some of the listeners here. And I think it's much more interesting than I thought. So my name is Drew Wahlgren. I'm on the capital markets side of our team here at MAG Capital Partners. So we're an investment firm. We specialize in exactly a little bit of what you said there: single tenants, triple net lease, industrial real estate. We've done quite a bit in the time that we've had since 2015. We own a little bit over $500 million in assets under management today. We've at this point done something like close to 100 transactions in commercial real estate, buying and selling. And so that's really the history behind us. And we've built up over time and really found this niche. And I'll get into even more specifics in a moment. But I joined the team a few years ago, and it was a group that I had known and participated with as a limited partner, invested with, really appreciated the model and the team here. And I just said, hey, look, I can help you grow on this side of the business. And but before I did that, I had been investing actively and passively. And really, early in the 2010s, I really chose to go passive, and I've always enjoyed that. I put a lot of my money into our own deals as an LP. I do my work here, but I don't want to get calls from tenants, and I don't want to get calls from property managers. Frankly, I want to spend time with my family, so we're all kind of working towards our personal freedom of time, right? And that's one way, I've been moving personally. And so just being able to offer what we do to other passive investors who feel the same way, it's pretty cool. So I've had a lot of experience in other asset classes, but I concentrate a lot of my ducats over here with the team.
Sure. Awesome. So I'd like for just to give us some context and kind of a starting point. You specified industrial. So I'm assuming I said shopping centers, you said industrial, but I'm assuming you're talking like big warehouse type buildings where some type of manufacturing or some type of storage or some type of industrial activity is happening. And the triple net part of that is I guess what makes it so attractive, because then it becomes almost a passive deal for the passive investor, or like you have passive investors investing in a triple net deal which almost makes it passive for the management company too, right?
Yeah. So sorry for jumping in, but we like that, right? We want to be able to, and you think, of course, a manager likes that, right? They don't want to lift their finger; they're lazy. Maybe a little bit of that,
Maybe no, I don't think it's lazy. I think it's got other things to do. Except I know that's what we say in the multifamily space. It's termites, trash, tenants, toilets. It's not necessarily that you don't want to manage it, but it's like, man, I could be off like making more money somewhere else or doing something that's
exactly.
change or unplugging a toilet. So anyway, go ahead. Sorry.
Exactly. No, absolutely. So it's not that we don't want to do it, but it is that we don't want to do it. And the reason is we want to scale. So I want to be able to do a lot of work up front, close on a property, sign a long-term lease with these tenants, which we'll talk about in a second, but be able to put this property on cruise control, because that's a little bit of what triple net lease is. People refer to it as mailbox money. That's really, it's very passive. And for an investor, I mean, I have people tell me all the time, they go, look, I'm already a passive investor. What do I care how passive the management of the property is, right? And there's a lot that translates to even a passive investor, which is really the insulation from all the expenses that can really eat away and erode cash flow. Right. Yep. You have a lease that protects you. And we take this a step further, and I can get into this in more detail, but really an absolute triple net lease where even the CapEx items, roof and structure and paving the parking lot, who's landscaping the property, who's responsible for that expense, all of that is falling on the tenant. So even though you're passive anyway, as an investor, I can go, well, I'm passive in a gross lease property where, there's a lot more operational risk, right? Management risk. How well is my manager doing managing these expenses? And even the best managers run into bad luck. Hey, we've done a property conditions assessment, but sure enough, a year or two later, things just, a property conditions assessment is anything but perfect. So
it's good for like 2 minutes because something's going to change.
Yep.
2 minutes later.
Down the road, exactly. So there's a lot of luck that can come with that too, and how conservative someone's underwriting is. So in this lease structure, I could say, look, I know what I'm going to get for cash flow, and I know that I'm not going to get eaten away by an increase in property taxes. And look at today, right, around inflation rates. Any manager who says, hey, we're going to get 15%, rent increases every year at this multifamily property, hey, that sounds great, right? What are expenses doing? And if they say, well, they're still relatively flat, you're crazy. All of your guys are going to need to get paid. Your landscaper, he's got to feed his family. The insurance company, they're going to say, look, we're looking at replacement costs. It's not staying still. Everything is moving up. They're going to adjust those premiums to go with it. So on all fronts, you're going to see those expenses move too, and that's okay. You just need to make sure rent's outpacing that. So for us, I go, look, your rent is a direct line to NOI. I know what I'm getting for NOI. So if I have yearly rent increases from a tenant, that's a really well-insulated net operating income increase that I can count on each year and not worry about what's going to clock me in the back of the head.
We've gotten a little further away from where I wanted to dig in about 2 minutes ago. So I'm going to stop you right there on that because I want to go back and I want to discuss this absolute triple net lease. Now, in my business models and the different multifamily stuff that we've been involved in and the other things like that, always look for where the human element comes in. Okay, because the human element is what ultimately at the end of the day is always, no matter any of us, I don't care who it is the wild card, right? So now I'm going to relate this to agricultural, to my ag background, okay? And one of the big things that happened here a few years ago was, I'd say a few years, probably been 10 years ago now, right? Land rents went like tripled in 2 years. Okay. Like they just went stupid high.
Yeah.
And so what was happening, Drew, and the human element that this brings in is the rents went up, but what happens is when you rent somebody's farm or you farm the land for that year, you fertilize the ground. Okay. Well, what you try to do over like 10 or 12 years is you try to fertilize the ground and get the levels up to a certain level. And what was happening is all of a sudden these these farmers that decided they wanted to farm overnight, like 2 weeks ago, come in and they realize, hey, this guy has been renting this farm for, say, $75 an acre. I can go in there and pay $200 an acre, and I can just use his fertilizer and take the levels back and not refertilize it and capture that expense out to pay the additional rent. And so what happened is ultimately what it amounts to is it was a degradation of the value of the property, right? And so I guess with this absolute triple net lease, the question arises, at least in my mind, is how do you keep people from basically using that and mining the value out of certain things so that when you take back the building in 10, 12, now obviously this could be a micromanagement thing that you're like, hey, our leases all cover all that stuff and they have to replace it. Because what ended up happening in the ag industry was what's called a fertility bond. And you had to sign that to assure the landowner that you would return the farm in the same fertilized condition it was when you got it now. But again, there's just human tendencies there because like basically the people that didn't sign whatever or found a loophole somewhere can just leave you holding the bag. And then rather than you having any control over it, how does all of that go and what does that work like?
Yeah, good question. Do they run the property to the ground, save money, and, hey, end of the lease, they're gone, and, good luck going after them, right? I mean, I think that's the fear is, are these guys actually keeping up with it? And what happens if they don't, right? So there's going to be a lot of, assessment of the property, and in the front side, we're going to be able to address anything that's really the next 2-3 years that we feel is needed, right? Hey, it turns out this roof actually, half the roof on this thing needs to be replaced in the next 2-3 years. Okay, we're going to work that into the lease requirements, right? It's going to be a little more specific language around that, a little bit more teeth around that. So, I'm going to preface this with a little bit of how we're acquiring these properties, which are sale-leasebacks. And we can come back to that in a moment.
Yes. Okay, go ahead.
But in short, we're crafting a lease at the front end. So we're able to put a lot of that language in the lease. We're not inheriting this lease and saying, okay, well, it's absolute triple net lease, but, there's nothing real specific about them having to replace the roof within, before 2025 or something like that. So if there is something really urgent, a large CapEx item, we can do that. But outside of that, if we say, look, this property's clean as a whistle and we have a 20-year lease here. Okay, what do things look like in 5 years, right? Do we have some siding starting to build rust? How does that get addressed? And, two things I'll say that one is typically these guys generally, I know there's a human tendency, but as a manufacturing operation or even a third-party logistics company or a food production company, you can afford to have your roof leaking on you. So, certain things they keep up with because they have some incentive there. Hey, I'm here to make money and my operation is going to be very successful if I have the building falling apart around me. So usually they take care of those things, but sure, they could let certain things slide and go. And we visit these properties, it's passive, but we still go out there every 12, 18, 24 months or so, come by, shake hands with the tenant. That relationship is more of a part of it, but you walk around the property and go, okay, here's what we're seeing. What's the CapEx schedule here? What's the plan? And usually these guys kind of are watching these things at the same time, right? So,
like you said, I mean, they don't want they don't want the roof leaking on whatever their stuff is they're working. I mean, how does that doesn't benefit anybody? And so, yeah, and I guess in my mind, like when I start thinking scale and I start thinking passive and I start thinking, I'm like, all right, I want to set that over there, and then I don't even want to talk about it again. Yeah, and that's part of the issue that I have with some of this computer automation stuff is automation and it's cool as hell until it doesn't work, and then it sucks because it's going to screw everything up, and it's the same. So I tend to be more of a black and white individual where it's like I don't really have the gray area of saying, hey, all right, once a week, go back and check that to make sure it's still going. So I just try to get that mindset. And like you said, if you go through, shake the hands with the tenant, because at the end of the day, that tenant is really a customer.
Right.
And sometimes it's hard to look at when you're the reason they're there, the reason for the capital investment, the reason for the private equity raise, whatever the case is. The customer is still that tenant, and they have to be taken care of. And if they don't think you're there and don't care, man, they're going to be looking for somewhere else.
Yeah, and they're a lot different than a, Joe Schmo on apartment 101, and he just might not really care. Hey, I know I'm responsible for this, but tough, come after me. And you don't quite get that because there's a little more recourse with a corporate tenant, right? Hey, here's a tenant. They do $100 million a year in revenue. We know they're profitable. In that lease, we require them to report financials to us on a quarterly basis. So we really know what's going on with them as far as
well, and what are their stockholders going to think? Like, hey, Drew over here with Mad Capital is suing us because we didn't take care of the heating and air unit on the building. So now they're suing us, and it's going to cost us twice what it would have had we just replaced it.
Right. Do they want to default on a lease just because they want to get around some kind of CapEx or maintenance? Yeah. And, again,
these whole different mind.
They're signing 15 to 20-year leases. So I think that helps too. If you're signing a 5-year lease, I think you might have a little more tendency to say, hey, I think I can kind of skate past this. And does it really need repair? I don't know. Yeah. It doesn't seem that bad. I think we can let it go. But when you're talking about 15, 20 years, you go, look, this isn't going to get any better. I'm not going to be able to ride this out for 15, 20 years. I need to take care of it.
And when I liken that to the ag business, I guess I needed to really say, a lot of these big, efficient corporate farmer wannabe guys were certainly smarter and more intelligent than, I don't want to say that. I don't want to say smarter and more intelligent because it takes a lot to run a farm. But a lot of the older farmers who had retired and who were leasing their ground to somebody else that had built that up, they were like, they just got starry eyed when people started talking about 3 times what they had been getting and a lot of them were depending on that for their income. So they didn't think about it. But
the new tenants were a little more shrewd. It sounds like, they said, oh, hey, I can come in, I can sort of, milk this a little bit, and
or even at that they could put half back and double the years that they were able to get good yields and so on, and so anyway, it was just a mess. It was a mess when it all started, and they've gotten, like I said, they've really gotten a handle on it now. But that was just kind of like the first place my mind went when we started like absolute triple net, where now all of a sudden. And again, you have to keep in mind, I'm a very black and white person. So I'm like, oh, yeah, triple net, absolute. The tenants over there, you don't ever see them again. You collect a check every month. Like you literally don't. But instead, no, it is. You're exactly right. When you're dealing with a big corporate tenant, and a lot of them are the manufacturers of items that go in the retail goods that we see, whoever they're supplying is probably really involved in whatever processes are going on as well. There's a radiator company here in town, and for instance, Toyota is probably more involved in their business than they are. They've got more say. Toyota has more say so in their business than. But anyway, but that's I think the way you see it, and a lot of that stuff happens. But so I want to chat a little bit about the sale-leasebacks. That's always something that gets me going because it's so relatively common, and I don't think a lot of people realize it. And I remember the first time I ever heard about it, I heard the Captain D's building was for sale here in town. And I was like, why in the hell is Captain D's selling their building? And then my broker was like, they're not really selling it. They're getting their capital back. And they're going to pay that capital back by in a monthly fee, but they're and anyway, it makes perfect sense. And Dollar General is a prime example of what's going on right now in the retail space. They go out, they build the buildings, they package them up, sell them to funds, sell them to individuals, sell them to whoever will buy them, and guarantee the lease for so many years at such a return, and that's it. So tell us a little bit about that and that part of y'all's business.
Yeah, I mean, this is something we specialize in. It's really the primary, vehicle of acquisition for us, and a lot of it's driven, like you said. What is a seller selling this property for? What are they doing? And most people kind of their mind immediately goes to, no one should ever sell an asset like real estate because we're all real estate investors. And so they think kind of one track, and they think, why would they do that? It must be because they're desperate. And that's just not the case. These are companies who they have a business. Their goal, their mission is to, manufacture metal parts for ATVs or whatever it might be, foam packing products. They produce frozen pies. I mean, these are some of the tenants that we have. And they're looking to grow the company. And frankly, the capital that's tied up in the real estate, there's a value to that, right? There's an IRR calculation to own in the real estate. And they put that right against the calculation of what the return on growth of the company might be with that capital. So if I'm sitting on $10 million, I can do a lot more with it to grow the company and turn a lot bigger profit. And, it may be used a number of different ways. We're going to invest in new equipment for a new product line that we're going to start producing. A lot of times the company may have been making some recent moves, a bolt-on acquisition. Hey, we bought Jimmy's, auto parts manufacturing down the street. We rolled them right in. We took on some debt to do it. Okay, now that we're sort of settled here, let's do a sale-leaseback. Let's take this capital out. Let's recapitalize our balance sheet. Let's pay down debt, essentially, right? I want to put myself in a strong position, and I'm a little bit levered up on debt here. How can I rebalance? And when they do a sale leaseback, like you said, hey, I'm taking on this rent obligation for however many years. So it's not free capital, but it doesn't go on their balance sheet. And so a CFO is going to look at that and be really attracted to that. Hey, I don't have this $10 million now in debt from a note at, US bank or something, right? That's not sitting on my liability side of my balance sheet. So I have this cash and I can be really flexible with it. The balance sheet is stronger and I can grow the company. And so for us as a landlord, you always want a strong tenant, of course. So they come out of that transaction stronger than they went into it. And so it's a nice thing to have, hey, these guys are profitable, but they're coming out of this, growing the company or having paying down a whole bunch of debt. Whatever that is, they're always going to be more liquid and a stronger position because of it. Now, here's the interesting part, and where we tie a lot of our acquisitions to is the private equity space, the mergers and acquisitions that are churning within that space. As a private equity company purchases a business, and they may own a dozen other businesses, and they're looking to roll these guys up or just have a complementary relationship to some of the other businesses that they own. And they buy the company and the real estate, and they come together. They put leverage on the whole acquisition, and then they spin off the real estate to us. We set up a nice long-term lease, and they're able to use that capital and inject it into the business for the growth, right?
Well, that's win all the way down the line, because the company gets their capital back. You all get to raise the private equity. The investors get to make a nice, solid, good return from a good long-term tenant and know that the property is taken care of because of brand is renting it, and then you all make profit. I mean, it's win all the way down, and all they're doing is buying the time back.
Exactly. So it's a liquidity event for them. And, mind you, I talked about private equity groups. So these are generally not publicly traded companies. These are private equity backed companies. It's private credit. Now, this is where it gets interesting, because if I have a Walgreens triple net lease property, I can really quickly go look at an S&P, credit corporate bond rating, right? They're double B minus, right? I know exactly what their credit is, how it's rated. And I can even go around and talk to brokers and say, hey, this credit rating kind of equates to around a 5.75 cap rate, right? It's a very kind of specific, I've seen charts that, people publish these kinds of things. Hey, this credit rating, and obviously there's other factors, location, real estate, all those pieces that factor in there, but it's a really small window there, and it's hard to compete there. If you're going to compete against an institution, you're always going to lose that battle, right? They have a lower cost of capital. They'll push the cap rate down further, and they don't mind taking a smaller yield for safety. So for us, we find this opportunity with private credit tenants where we can really take that responsibility for credit risk into our own hands. And we've built up our team over time to be able to do this, bringing in credit analysts from big publicly traded REITs, and they're joining our team, and we're digging in because you can't find a corporate bond credit rating out there that's published. These guys aren't publicly traded, and it doesn't mean that they're a small mom and pop. A lot of these businesses, they've been around for 40, 70, 80, 100 plus years sometimes, manufacturing, security locks, manufacturing aluminum gears and sprockets for a number of different industries. Very boring, under the radar industries, but they're churning hundreds of millions of dollars in revenue.
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show.
They're profitable. There are companies that, you drive past these buildings once in a while, you might see a sign that says, AEI Industries, and you go, oh, I don't know what the hell that means. That's very vague. It's very under the radar. And again, they're not customer facing. So, who are these guys? Well, a lot of them are privately held. They're, really well tenured companies, really established companies that have survived every presidential administration, every war, economy, every recession, right? And they've been around for all of that. And I think that speaks a lot to the industries.
And there are a lot of times the backbones of the big brands, and the brand is what's customer facing. But if it wasn't for, and again, that's where it comes back to in my opinion, the American worker.
Yep.
Like Tommy, like the movie Tommy Boy said, I'm about the American worker. And that's so it leads back to the American worker who works for a company that supplies parts for such and such brand, that's customer facing, that's simply responsible for putting all of these pieces together and making said item.
Exactly. Yeah, a manufacturer or a company that's sort of assembling a product, like I mentioned, ATVs or what have you. I mean, we have one particular tenant who makes a very highly engineered piece that goes on the inside of a flooded lead acid battery, the same kind of battery that's in your car, truck, golf cart, forklifts. They even use some big ones for, really remote infrastructure applications. So, the battery company, they make the whole battery. Why don't they make this piece? Because this company has about a dozen different patents on super specific designs where it's a separator wall inside of the battery that has pores that are 100 times smaller than a human hair. They allow ions to travel freely between them. And it's something that they've been doing for over 80 years. They know what they're doing. So these guys, very specialized. They produce this. Again, they have patents, and they do over $100 million in revenue a year making battery walls, a very specific part. So that's the kind of tenant we like. And they're, like you said, these are companies that are driving the American economy. It's sort of, our society wouldn't function without a lot of.
If they're there to do $100 million a year in revenue, they're not worried about your $500,000 roof. They're going to put a $500,000 roof on it and keep chugging.
Right, exactly. So, and they're not going anywhere. Like, we signed a lease with that particular tenant at 20 years. Yep. They have no intention to leave. In fact, and I wanted to get into a little upside here and how we can add value and get into the juicy parts of triple net leases. But in this particular example, they said, look, we're growing. We need another 40,000 square feet of just storage for outbound product, for inbound materials, for the production side. Can you help us? And we've done this a number of times with tenants, and we develop an expansion. It's built to suit. It's almost zero risk, right? You look at it and you go, look, at the end of the construction here, we're going to amend the lease with this new square footage at a pre-negotiated cap rate of based on construction costs. And at the end of the day, I just amend the lease, and my NOI just went up by however much that was. So It's a really nice value add there, and we can work with these tenants
because at the end of the day, the NOI determines the value of the property.
Exactly. Exactly.
That's
so ultimately, real quick, just because we were talking about the lease structure, and this is one I really don't want to forget to talk about, and it's. You brought up tenants who may not, perform the CapEx that's required down the road. Well, here's what happens. And, we talked about how they're not going to avoid that too much, but sometimes, if they're a little less liquid, or they're looking at, hey, how do I get this roof replaced? We know we need to get it done. It's about $1.5 million, large property. Okay, how are we paying for that? And a lot of times they'll tell us, and they're required to get everything approved by us, of course. So long story short is we'll offer, hey, we will finance this for you. right? You're still responsible for it, but we'll capitalize that into the lease. And it's a fantastic value add. We're able to essentially finance it through the lease rate. Now, you have to have some room there, right? If I'm at or above market, it's going to be a little tough now for me to say, hey, we'll finance this and we're going to raise your rent. I don't want to be well above market. That's a risky place to be. But if I'm below market, that gives me a lot of room to wiggle and say, hey, we're going to go ahead and, let's just make a round number here. It's $1 million CapEx. We'll raise rent by $100,000 a year. And, that's paid off over a course of, 10 years. Plus, we're going to add some interest there. And so it's a nice value add. So maybe it's an extra $110,000 a year in rent. Now, divide your 6.5% cap rate or whatever that is into that rent, and you see what kind of value you just created in this property.
Well, and just to create a little market with your scenario there, the other, you could say, hey, we'll take care of the roof, or we want a extension on your lease, or we want you to, any number of things that carries that relationship or makes that relationship even more like you're always looking for. And when you get right down to the brass tacks of it, you're always looking for what works for everybody, what benefits everybody, what makes everybody want to continue forward with what's going on right now.
Mutually beneficial. 100%.
Mutually beneficial. That's exactly right. And that's what it's all about. Every bit of it. Every bit of it's all about mutually beneficial for everybody. So, all right, Drew, listen, we're running out of time. And with that, I want to thank you, first of all, for taking the time, because, again, this discussion has been far more interesting than the subject topic has been to me in the past, as far as just you're like triple net leases. Yeah. A client comes in, they release. So anyway, thank you so much for making it a very interesting topic for us to discuss. First question that we ask every guest that comes on the show: what is the best book that you've recently read or are currently reading?
Currently listening to an audiobook. I know I'm a cheater. I hate to read.
Hey man, you can duplicate that time if you can use the ears and use your hands for something else.
Absolutely. And a lot of times it's driving for me. So I listen to Am I Being Too Subtle currently by Sam Zell. I know it's kind of a favorite by people, but he's pretty funny. And I think he self-narrates the book, and he's got
ready to ask, if he self-narrates it, man, that's you're onto something there for sure.
He's got a raspy voice like Louis Anderson, man. Yeah. He's a character.
Yeah. Awesome. All right. What is a dream vacation that you've taken or hope to take?
Probably the best one I've taken was to Iceland. I really loved it. I went in the dead of winter.
I get Iceland on here all the time. I'm like, where the hell have I been?
Yeah, you go. Everyone goes in the summertime. Don't be a pansy. Go in the wintertime. Battle the elements. I mean, you go out there and it's not only beautiful, not only is there way less people there, but you have this real a certain amount of danger that comes with it that sticks with you. And, we all want a little bit of risk, because otherwise, who cares? No one wants to hear about your vacation unless you had a little risk.
You gotta bring back a good story, don't you? I mean, you have to. If you don't have a good story, then I'm sure, man, battling the elements in Iceland, be like, hey, just saying that is a story in and of itself. So awesome. All right. Well, listen, Drew, if somebody heard something that resonated with them, or if they're interested in investing in one of your deals or one of Mag's deals, whatever the case might be, what is the best way for people to reach out and get in touch with you?
Yeah, they can email me. My email is Drew, DREW, @magcp.com. And just send me a note. Happy to chat about what we do. We bring on partners with us. If you're interested in learning more, just reach out. Happy to talk.
Awesome, man. Awesome. Listeners, as always, thank you so much for your time today. Drew, thank you for your time and again, making triple net lease discussion at least digestible and actually breaking it down into terms that all of us can really use and understand. Listeners, again, thank you so much for your time. And please head down and smash the subscribe button, first of all. Number two, please leave us a review if you enjoyed today's podcast. And I hope it's a 5-star review. And Drew hopes it's a 5-star review. So if you don't care care, head down and do that. And I hope everybody has a wonderful rest of the day. Thank you.
CashFlowPro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.